welcome back to Metro Morning Live. 11 minutes now past the hour. Time now for our segment we call You and Your Money with our financial expert, Jim Griffith. Good morning, Jim.
Good morning, Rob. How you doing?
Pretty good. Doing pretty good there, Jim. We're going to jump right into it this morning. We're going to talk about taking distributions from retirement accounts.
Absolutely.
Okay, now how important is that, Jim? What we need to know about that?
Yeah, that's real important, Rob. The main thing you need to know is that distributions coming from a retirement account are governed by the IRS rules. So when you pull that money out, there are a lot of restrictions and conditions. One is that taking the money is a distribution. There are a variety of ways to take that distribution, and there are several different types of accounts. You've got 401ks, 403bs, Roth IRAs, and you've got other investments like brokerage accounts and money that's sitting in savings accounts.
So what distribution should be taken out first?
It's going to be different for each individual, needless to say. But the rule of thumb is you want to take money from the taxable distributions first, number one. Retirement plan distributions are taxed. So if you pull the money out before 59 and a half, there's a 10% penalty. And once you get 70 and a half, the government, the IRS requires you to take money out of the account. If you don't take that money out, you're going to get assessed with a 50% penalty and have to pay taxes on the money that you don't take out. If you have a Roth, the money that you put into those accounts, you have to let that money sit there for 5 years, and then when you get to be 59 and a half, you can take that money out tax-free. Also, the owner of a Roth is not required to take any required minimum distribution. So that's another benefit of having that type of account.
Okay. Are there different types of accounts?
Absolutely. There are basically 3 different types of accounts. You've got a taxable accounts, which are investments, savings. You've got tax-deferred accounts, which are the 401ks, 403bs. And then you've got the non-taxable accounts, which are basically like Roth IRAs.
Okay. Now, what account should you take money from first?
Basically, what you should do is look at your individual situation. The rule of thumb is to take money from the taxable accounts first, let the money sitting in the tax-deferred accounts continue to grow while you draw down on that first bucket of money. Then take the money from the tax-deferred accounts, and then take money from accounts that are tax-exempt, like your Roth IRAs.
Okay.
And again, always make sure it's going to vary from individual to individual.
Now, how can the distributions be taken?
In some cases, you can defer taking that distribution because they have what you call a continuing to work rule in the IRS code. But in general, what most people do is they take a lump sum distribution. They'll take a rollover. They'll annuitize it and take that money over a period of time until they die. And then some people will use a combination of all of those strategies.
Wow, that's a lot to know, Jim. Now, what distribution strategy should be used for this?
Yeah, primarily rule number one is always protect what you have. So you want to protect that initial principal that's generating the income for you. You want to have a strategy that's going to generate the maximum amount of income, and also have a certain part of that money positioned so that it's continuing to grow for you.
Now, when it comes to distribution rules, what should we remember?
Yeah, remember that required minimum distributions are based on age, account value, life expectancy, and also remember that there is a excess accumulation penalty, which I mentioned earlier. Once you reach 70 and a half, the IRS makes it mandatory that you take that distribution. That's why they call it a required minimum distribution. If you don't take it, you pay 50% penalty on the money that you don't take, and you pay taxes on the money whether you take it out or not.
Wow.
Then keep in mind the exception to the 59.5% rule. What we mean by that is that you're restricted from taking money out of those accounts before 59.5. You'll get assessed a penalty. But there are some exceptions, and one is if you have unreimbursed medical expenses, you become disabled. You can take money out in many cases to pay for higher education expenses. If you're looking to buy that first home or build that first home, you can access money in those retirement accounts. And another thing to remember is to make sure that you name the beneficiaries on things like your IRAs, so that that money gets transferred to the person you want to go to. And if you're a single person and you don't have a spouse, be very, very specific if you wanted to go to a particular charitable organization, or if you wanted to go to a religious institution, because if you don't, that money could get tied up and get difficult to get to.
Wow. Now, let's talk a little bit about Social Security. When should you start taking Social Security?
Yeah, Social Security, there's a number of different plays on that. But in general, most people start taking money from their Social Security accounts when they get to be age 62. Now, you can delay until age 70 and the check will be bigger, but the norm is that people actually start taking that money at 62. They'll take a smaller check for a longer period of time.
Wow. I got a long way to go to get that money, Jim.
Well, it's coming. One thing for sure, you will get there, one way or the other one, I hope.
Well, but they're trying to raise the age on Social Security now, so I don't know, man.
Yeah,
You never get that money.
Well, we will have some changes coming, that's for sure.
Well, what's the key takeaway about retirement plans?
Yeah, the key takeaway, number one, is to start saving as early as you possibly can. Save as much as you can so that you can take the advantage of the power of deferred growth and compound interest. Now let's take a look at a little video clip we have here that'll kind of drive this home so everyone can understand what we're talking about.
Deferring taxes can be a powerful investment decision. The dollars that would have gone to paying taxes remain in your account, which means more money working for potential returns. Here's how it works. Say you invest $10,000 a year in a taxable account earning 6%, and your tax rate is 25%. After 20 years, your account would be worth nearly $330,000. A tidy sum, but that same money put in a tax-deferred account would be worth nearly $390,000, $60,000 more. That's one of the reasons why 401k plans are so popular. Combining tax-free contributions with tax-deferred growth can be a sound long-term strategy. Other accounts also let you delay paying taxes. Individual retirement accounts, or IRAs, allow money to accumulate tax-deferred. Wealthy investors see the benefits of traditional IRAs. At last check, 64% of households with annual incomes of $200,000 or more have at least one IRA. Roth IRAs don't offer tax-free contributions, but they do offer tax-free growth and tax-free withdrawals. Created in 1988, their popularity is increasing. In fact, nearly 40% of households owning accounts have opened them since 2002. Annuity contracts, which trace their origins back to Roman times, also offer tax-deferred growth, and contributions are made with after-tax dollars. There are many different types of annuity contracts. A review of your unique situation would help determine if one is suitable. Put the power of tax deferral to work for you. Call today so we can review your retirement strategy.
All right, Jim, always great information as usual. Anything else you'd like to add about that?
Just the key thing is that when it comes to planning for retirement, make sure you pick the right retirement plan. We've got traditional 401k plans. They've been out there for quite some time. There is some problems with that. It's kind of been a failure for Americans when it comes to planning for retirement. We use a plan that's a non-qualified plan, so when you pull money out of it at retirement, it's tax-free income. It does not affect taxation of your Social Security. You also get a legacy transfer when you die, and money to address issues as you get older for long-term health care. So give us a call. Definitely let's get that annual review in. And before you take that distribution, call us so that we can assist you to make sure you make the right decision, because that money needs to last a lifetime and also be positioned so that you can transfer wealth to the next generation.
Okay, and how can they reach you?
Yeah, you can get in contact with us by calling 800-361-6542, or you can get us at griffithfinancialservices.com. That's our website, and you can contact us. All of our information is on that website.
All right, thank you, Jim. I certainly will be calling you in the days to come.
Okay, well, I will be looking for you around. Call me when you get to be about 59 and a half, and we'll make some magic.
Oh, that's going to be about 20 years from now,
No,
Jim.
we'll make some magic happen.
All right, we'll be back tomorrow.